And this is Real Estate Underground.
Greetings and salutations, Real Estate Undergrounders. It's Ed Matthews again with the Real Estate Underground podcast. Today, I am joined by Chad McMahan. And Chad, if you don't know who he is the CEO of Giant Capital. He is also a realtor with about 25 years experience in the Sedona area. So if you are looking to buy your dream home in somewhere in the Sun Belt over in Arizona, that is, Chad is someone you definitely want to look up. He is also the co-owner and manager of the equity team. And we're going to get into all of this stuff during this conversation. But first off, Chad, welcome to the show and thank you for your time today.
Thanks, Ed. I appreciate it.
Yeah, absolutely. So Chad, one of the things, and we were just talking about this offline, one of the things that's really hard about interviewing someone like you is you do so many things and do them at such a high level. We could talk about buying and selling real estate. We could talk about real estate investing. We could talk about, private equity funds. And I'm sure there's about 19 other things we could talk about that I don't quite understand yet, but we will. So Chad, for those folks that understand or haven't met you or haven't seen you online, why don't you tell them a little bit about who you are and what you do, and then
Sure. So I'm very passionate. In fact, I would even say I'm obsessed about real estate investing. And so that's been the case since somewhere in college. I went off to ASU in the Honors College, and somewhere in there, I just started to get the bug. I got the itch, and after college, I started investing kind of small time. So I was a very passionate and just both feet in the deep end with investing, and I was self-educating. So I was going to educational conferences and reading a ton of books and doing all that kind of stuff, reaching out, looking for mentors. And, I started with hard money and I started with seller carries because I had no money. I didn't have any money at all. I didn't have any, I wasn't a trust fund kid or anything like that. So, I built up my net worth that way. And I got to the point where I could have, I had the credit and I had the ability to start getting conventional financing, and I had the cash to start, getting LTV that wasn't 100% or 105% LTV. And so then I got into that and, maxed out what I was able to do with conventional banks, and I started doing non-conventional banks and just kept expanding. And I liquidated everything right before the 2008-ish real estate crash. Liquidated right before that. I'm the one you heard about. No.
Yeah.
And
there's one guy.
Yeah, and it was kind of dumb luck because I was so stressed out. If I was going to just be an investor again, which someday I'm sure that'll happen, I would approach it differently.
Sure.
But it was so stressful because of the way I was running my investment business. It was successful, but it was stressful. And ultimately, I don't think it was worth the stress. So I liquidated everything. I got out of it. I took a break for a couple years, and I decided that I wanted to use everything I learned in that, got into the real estate business as a real estate agent, and become an investment specialized agent. And so I work with investors primarily luxury buyers and sellers.
Yep.
And so got into that, got really passionate, and have been doing investing plus real estate agent business. And then, formed along with two other general partners. It's myself as CEO, and then my other general partners are William Hamburg as the COO, and Mark Sterling as the CFO. And that's with Capital Giants. So that we just launched it. We've been spending quite a while kind of building up to it, creating the systems, getting everything lined up. But everything that we've been doing in syndication for years and highly successfully, we've rolled that into this fund. So the returns we're going to be getting are very reliable. They're proven over and over and over again with what we've already been doing. It's just that we've been doing syndications, and now we're going to do it within the fund, and we're going to just rinse and repeat with copy and paste, rinse and repeat with what we've been doing.
So I'm curious, what made you move from a syndication model to a fund model?
Well, both are good depending upon what your goals are, but
Sure.
there are a few reasons why we decided that we just had to create this fund. And I'm just going to be this way I am with everyone. I'm going to be just super transparent. I'm just
Bring
going
it
to
on.
let it just puke it out
Lie.
there. Okay. Just let you
Just
have it
remember it's a
all.
family show. Other than that,
Yes. Okay. All right. Fair enough. I'll be careful. So, the first thing is that the tax bracket on the profits is quite a bit lower than with syndication. You're looking at things like capital gains and things like that with the syndication, much higher tax that you need to be paying on your profits. With a fund, it's called carried interest, and your tax is much, much lower. And so that's the first thing. And that goes for not only the fund, the general managers, the general partners, but that also goes for the limited partners. Everyone plays by the same rules with a fund. And so everyone gets that benefit. And I really like that. The other thing that I really love about a fund is I wanted to be able to invest and support limited partners and help them make as much money as possible with having them truly be silent partners. Because my business partners and I, we have the experience, we have the way to run it. We don't want any muss or fuss. We want to be able to just do it, take the money, get the best outcome, and make everyone the most money. With syndication, legally speaking, you're open to things like hostile takeovers. If you get someone that's having a really bad month, they can make everything terrible and become a nightmare for everybody. But in a fund, limited partners don't have the legal authority. They don't have the power. They don't have the potential to grow into that much of a headache. I mean, aside from, maybe if reality is not aligning with their expectations and they're just upset or whatever it is, you just have to work through it.
Sure.
But as far as what's going to happen with the money, with the properties to get the outcome you want, that is up to the general partners, which is really, that's how we like it.
Yeah,
and
absolutely.
We have the experience and the ability and the network to really kick butt, to really get it done. And so we love that. We are hungry for that.
Yep.
And that's what we want. The other thing that I really love about the fund versus syndication is its diversification. You're putting all these properties into the fund, and limited partners benefit from everything. And then another thing that really sticks out in my mind and in my heart is our vision statement. Our vision for this fund is twofold. It's to benefit the neighborhood and the communities where we invest. And we do that in a lot of very profound ways. But the other thing is that there's a part of our general partner profits, not the limited partner profits, but the three of us that are general, the fund managers. Part of our profits goes towards planting trees, where they're needed most in the world, because we're human beings, we're making a really nasty imprint upon this world that we live in, and that's a way that we can give back as well.
Yeah, well, the trees are our air filter, so thank you for that. I appreciate it. On behalf of all beings who actually need oxygen to survive, we are grateful. So thank you for that. That's good. So, one of the things you just said kind of really resonates with me as well. And that is, I'm in the multifamily space as well. And, one of the things I jokingly tell people is we buy, so I'm a value-added C player, right? A Class C building player. And so, a lot of the work we do locally here in Connecticut is we buy crappy apartment buildings from landlords who really aren't that good at their jobs, right? Yeah. And, the goal is immediately make them clean and safe, upgrade the common areas, and then over the course of time, upgrade every single unit, brand new kitchens, brand new bathrooms, new floors, new lighting, new everything, right? And, the idea being that, first off, there's an ethos to that, right? And, I think that property owners get a bad rap in a lot of cases. But in most cases, that the term slumlord is a well-deserved term, right? For a certain sector of our business. And so, like you, one of the things that I'm looking to do is, provide a home where someone, it's clean and safe, and somewhere that, people can be proud to live there, right? And, there's the moral and ethical piece of that, which I really like sleeping at night, like you, it sounds like. But the other part of it is that, the good news is that when people are proud of where they stay or where they live and they make a home there, they take better care of the building. They pay their rent on time. They stay a lot longer, and vacancy in our world is one of the most, if not the most expensive thing. And so, there's a whole ethos around, doing it right. And so, when I hear you say benefiting the neighborhood, and, I think of another term that, a friend of mine, Rich Brown, talks about, giving rise to communities. And, it makes it really, first off, it feels like it's the right thing to do, and you're doing well by doing the right thing, which is doesn't happen a lot in this world. So it's something to be admirable. And anyway, I'll hop off my soapbox, but the fact is that I appreciate and respect when I meet, an operator like you, who's not only committed to serving his or her investors and providing a return, and in most cases, sounds like in your case, it's a superior return, but also, doing right by the folks that actually live in your buildings as well.
Yeah, back at you, and well said. Absolutely.
Yeah. So when you look at properties, and you create that buy box that all everybody talks about, right? So what does that look like in your world? And let's start at the geography first.
Okay.
How do you pick a target market, and then we'll drill down into the buildings?
Good. So our investment thesis is multifamily long-term rental properties that are in Arizona.
Okay.
Not always, but typically they're going to be anywhere from 10 to 100 units.
Okay.
Usually they're going to be more like 20 to 50 units, but it really just depends upon where the deals are. And so because they're in Arizona, we're looking at, and the reason why we chose Arizona, because in our case, Arizona is in the top 7 or 8 states in the country to watch in 2023. And this is based on company growth in the tech industry that's coming in or is expanding within Phoenix, within Tucson, within other parts of Arizona. And also it's based on population increase, which of course in Phoenix is massive. It's always going to be massive. It's just a flat city that's just expanding like crazy. So especially in the core parts of Phoenix, the demand is only increasing. To live there, and that raises rents, and occupancy rates are strong, and all of those factors. And so that's our investment thesis. And I believe you also asked, kind of how are we choosing each property when we're doing acquisitions?
But I want to talk at a high level first. So when you're looking at the geography, I mean, obviously, where you operate in the, Tucson, Tempe, Phoenix kind of area, right? It's a target rich environment. The real estate market there has been tremendously healthy for years, and maybe I would submit maybe even more than a decade, right? And so, but here in the East, so I'm in Connecticut, we keep hearing about those hot markets are starting to cool off, and Phoenix is one of those places where it's starting to cool off. But they're usually talking about single family homes, and I'm going to defer to your expertise, given that you do both. Those articles in the Wall Street Journal and the New York Times and anywhere else you read, are really referring to single family homes, and multifamily is sounds like still alive and kicking.
It is. One of the biggest indicators that we look at now when it comes to the multifamily is we're looking at what are the vacancy rates. And that's something that has, again, full transparency, it has taken a small hit. It's taken a small to moderate hit over the last 9 months. And part of that is just economic struggles and things like that. A lot of people are really hurting right now. So that has occurred. But, the bottom line is that there are a lot more people renting than owning, and they have to live somewhere. And the population continues to come in. And the expansion, the growth of places like Phoenix is happening more slowly than people are moving into the area. So what that means is vacancies are going down, and that's what's starting to happen right now. And with all of the tech growth and things like that, that's happening in Phoenix right now, we're seeing a lot of worker bees, that are coming on out, and they're moving into the area, and that creates other jobs because they've got to, you're going to see more grocery stores, and you see gas stations and all these restaurants that are popping up, and then all of a sudden you got more jobs, and so it's really a big win for the state of Arizona. Now, the only thing that concerns me, and anyone that's thinking about putting down a big chunk of change, with investment, they should be looking at what are the potential windfalls here? What are the potential problems and things to worry about?
Right.
And you've always got to take an honest look. There's no perfect place to invest. And really the biggest concern that I have in Arizona, just like a lot of the states in the Southwest, is water. It's water. I mean, that's one of the things that it's already becoming news. And for the last, if your viewers are familiar with, there's a website called Bigger Pockets. And on Bigger Pockets for the last 8 years or so, I've been saying, guys, we got to, heads up, we got a water issue that's coming. We're going to have this problem coming. And we're going to see this problem in 5 or 10 years. It's going to be significant. So just be aware. It'll be solved somehow, but it's going to impact things like real estate.
Right.
And here we are. And now it's becoming national news, and it's really going to become national news over the next 2 years. I mean, it's now. The time is now. So we're seeing problems that California has been having, and some of the other states. So anyway, it's important to just be aware of these things. It doesn't mean don't invest in Arizona, but it means that you have to buy properties in Arizona where you're considering that factor and how much that's going to impact that investment.
Indeed.
And for our fund, we are doing a 5-year exit. Our fund life is short, it's just a 5-year fund life. And for viewers that don't know what that means, that just means that we're going to sell everything that's invested within the fund within 5 years. So I feel highly confident with a 5-year fund life. But if this was a 20-year fund life, I would be concerned.
Yeah.
I'd be concerned about that. And I would probably choose a different state, to be honest, or I would choose maybe short-term rentals in Sedona instead, because Sedona has an independent water aquifer, underground aquifer, that has a 500-year plus life of water. So Sedona is insulated from the Arizona and Southwest problem of water.
Really?
So it's just really important for your viewers to just consider these things and make sure that whether you invest in syndication, invest personally, invest through your trust, invest through a fund, whatever it is, that's part of your due diligence before you pull the trigger on something, that you want to just make sure that you're protected up until your exit.
Right.
And I also recommend that, people have multiple exits.
Yes.
And that's one of the things I learned in investing. I had my immediate exit plan, I had my 3-month exit plan, and I had my break-even 6-month exit plan, when I was investing and doing nothing else.
Right.
And that's really critical, because not only does it force you to learn about your market, but it protects you, protects your money, and protects your family.
Always have a plan A, B, and C, right?
Yeah.
Without it, and if you don't, stop, because you're about to make a mistake, right?
Yeah.
No one's
exactly
perfect.
Right.
No one has a crystal ball. No one can see. I mean, heck, no one can see even 5 years out. Although I think your horizon, your time horizon is well chosen, and clearly, you've gone into thinking. I'm curious about, knowing what you know in the market. The person who comes in and buys, the entity who comes in and buys those properties, what's their thesis in terms of how environmental issues are going to impact, that portion of the desert, right?
Mm-hmm.
For instance, like in Florida right now, I was talking with an insurance agent who has a national practice, and he was saying that the insurance industry is in uproar right now because of all of the global warming is clearly the driver, but we're looking at catastrophic losses from hurricanes and major coastal storms, different than what you're dealing with. But what's happening is that the insurance rates are doubling basically on properties in Florida, in Alabama, in Mississippi, anywhere that Louisiana, where there is a potential for a hurricane to hit, and we're talking Cat 4, Cat 5. It's changing the entire dynamic of the real estate industry, because
Wow.
you have to plan for, a 500-year storm coming every 10 years. Right?
Holy cow.
Right.
That's unreal.
Right. So
yeah, that's amazing.
Yeah.
That's definitely a big impact. And,
Yeah.
as investors, we have to be adaptable.
Right.
We have to. The investors that I see failing, and I have an example for you. The investors I see failing, they're the ones that keep running business as usual.
Right.
And they're not constantly pushing the envelope. They're not constantly, self-educating and trying new things. And so an example of that is actually, and again, I'm investment specialized as a real estate agent. So I work with a lot of short-term rental buyers. And so the example is that, you go back about 8 months ago or 9 months ago, and, market was hot. Everyone's super excited, rip, rip, hurrah, lots of cheerleaders out there, everyone's just pumped. Right. And buying up properties, and maybe people already owned 1 or 2 or 20 short-term rentals, or they're just buying one and they're looking at their neighbors. Everyone's getting 80% occupancy rate. It's really exciting. And then the market softens. And with a softened market, now you get 80% of short-term rental owners that are getting about 50 to 65% occupancy rate. And most of them are just breaking even now, which is really, that's just heartbreaking. And so, and then on top of that, you've got property values that came back down. And so you got a lot of people that are underwater with their mortgages. They're either breaking even or maybe losing money every month, and they're just wringing their hands and pulling their hair out, saying, "What is going on? I don't know what to do. Should I sell this thing? Should I put it on as a long-term rental? Should I do a midterm rental? I don't know what to do." And they're reaching out, asking for advice and all this kind of stuff.
And their heart is doing this
and their heart is doing this, and it's jumping out of their chest. And so that has actually been an enormous opportunity for me, and business has never been better for my real estate team, called the equity team. It's never been better because we know how to get 80 to 95% occupancy rate based on what's happening now. That's the top 10 or 20% performance of short-term rentals on the market. And so, with predictability, and I'm not going to say it's easy because there's nothing easy about it, but based on what we can line up for our investors from A to Z, we can get them to 20 to 40% cash on cash returns. They're looking at huge ROIs. They're going to be getting at least 80% occupancy rates. And you have to change how you do business.
Adapt and die, right?
And my heart really goes out to a lot of there's so many short-term rental owners right now that are failing, and they're super smart people, and they're struggling and they're failing. So, I'm one of those guys that's always saying, "Hey, look, reach out to me, no strings. If I can help you, if I can consult for you and give you a kick in the pants to help you increase your occupancy 20%, then I want to do that for you."
Right. Yeah. Serve the community. Right. And that'll come back to you. For sure. They're going to want to buy another one, or they may sell at some point, and
that's right.
First phone call. So that's an easy give, right?
Absolutely.
Yeah. So in terms of, so what I'm hearing is, no matter what you read in the Wall Street Journal, it's time to buy in Sedona. That's what I'm hearing.
If you do it right. Yeah.
Do it right.
If you do it right,
well, I'll be on a plane this weekend. I'll see you Saturday afternoon. Fantastic.
Sounds good. I look forward to it. We'll go have some appetizers and drink some wine. It'll be good.
Right. Oh, beautiful. I'll buy. That's fine.
Sounds good.
So Chad, it's really interesting. You've got your hand in, 3 different asset classes, right? In terms of single family homes that people are buying, to live in, right? You've got multifamily and you've got, the short-term rentals. This is the part where I ask you, tell me who your favorite child is. So if you were to do it over, knowing what you know over the next, 5-10 years, where is the smart money in your market being placed? What are reasonable expectations to expect?
So I've got a 2-part answer for you. Yeah, it's such a good question. It's a two-parter. I've got two answers for you. So the first thing is with a fund, this is another reason why I love funds, is we're actually going to have our cake and eat it too, because we're going to do this first fund. And then once we have our max investment money in, we're going to close that fund. No one else can put even another penny in. Even the other investors, if they say, Chad, I want to put in $1 million, they're not going to be able to. It's like locked.
Yep.
And once we get to the point where we have spent that money and purchased the properties and then developed those properties to max amount, we're going to start fund number two. And fund number two won't be the same. It's going to be, right now, honestly, we haven't decided, so I'm not even going to throw it out, but there are about 3 or 4 different things it may be, depending upon what's going on in the market at that time. So for now, multifamily long-term rentals, we chose that because the risk is the lowest for our limited partners.
Yep.
That's why we chose that.
Yep.
We know we can get great returns, and it's much less volatile than short-term rentals. Even though I'm consistently getting these crazy, amazing returns for my clients and for my own short-term rentals that are in the Sedona area, that is a volatile market compared to multifamily market.
Yeah. And,
there's no projection or forecast for laws to change where people can't rent out long-term rentals in multifamily. I mean, there's such a need for that.
Right.
And there's no debate on that, but there is a lot of debate on short-term rentals, and we have a lot of markets that are starting to restrict more and more. You have some states, not in Arizona, but you have some states that are saying, look, local municipalities can decide. And for example, parts of Colorado are just saying, nope, no more, no short-term rentals, not going to do it. And they're just shutting it off. Arizona, fortunately, is short-term rental friendly. And that's a beautiful thing. So that's the first thing.
Okay.
The other thing I would say is, I am obviously a fan of the short-term rental market. It's really good money. And I would say that, you hear it both ways, but based on what's happening with interest rates and what the forecast is for 2023 with interest rates, they are expected to come back down by the end of the year.
Yep.
Which is going to be a huge factor for increasing property values,
right,
as well as buyer activity.
Yep.
And even though we just had a bump in interest rates for the last 2 months, I've been noticing significant increase in buyer activity. I've been seeing a lot more buyers, buyer cash, and I've been seeing a lot more buyer courage. And so those things, if you see a really attractive property, for example, which, by the way, that's my biggest point of advice for short-term rental buyers, make sure it's something that's going to have marketing pop. Make sure it's something that it's not your boring typical home. Don't buy cheap. You got to buy something that's going to stand out as an attractive. It doesn't have to be super unique, but an attractive property that is going to photograph beautifully. Yep. And it's also going to check enough boxes where people are going to be like, oh, yeah, we got to stay there.
Right.
That's
it's
super comfortable. Pamper my kids, pamper my wife, the whole bit.
Right.
So, but yeah, short-term rentals, it's a great market if you do it right. If you don't do it right, don't bother. Right. And if it's your first one, be careful about self-managing, because it is hard when you start out.
Right.
So,
right. It is. So Chad, we're getting towards the end here. Thank you so much for your time. I'm curious, I know you're from Southern California. My dad lives in San Clemente. I wanted to mention that. So
sure.
Nice. My kids have always wanted to go to the surf school that's there. And when you're not slinging real estate in some way, shape, or form, or investing in it, what do you like to do with your family?
Yeah. Well, I mean, this weekend, I'm actually, my 2 sons and my wife, we're going to go out and play in the snow in the mountains. So if it's wintertime, we like to go where the snow is. Yeah. If it's not snowy, we like to go wild crafting. And even though Arizona is technically desert, there's tons of stuff out there if you know what you're doing. We researched it like crazy. So we go wild crafting for mushrooms, and we just all sorts of stuff. And we love that, biking and hiking and all that good stuff.
So as a New Englander who has no idea what that is, what is wild crafting?
Wild crafting is when you go out into nature and you pick what is edible and you eat it. I mean, that's the simplest version. It's finding plants in nature that are edible and just having a hoot.
And rolling the dice.
And well, no. Before we did it the very first time, we had already read half a dozen books.
Right.
With mushrooms, you got to be so careful. Go with an expert. When in doubt, don't pick it.
Right.
And read a ton before you even try it, because mushrooms are extremely poisonous. And sometimes you get one that looks like an edible one, but actually it's going to kill you. So just be very careful with that.
Or make you have a very interesting afternoon, right?
Yes, exactly. That could happen too. Yeah.
So, or they're fantastic on steak. I mean, it could be.
Yes. Oh yeah.
Right.
We have something out here called lobster mushrooms, and believe it or not, you cook them up, they look like lobster, they smell like lobster. They've got like this lobster nutty flavor. It's the most amazing thing. And so my kids and I really love hunting for those.
Oh, that's cool. Yeah. A friend of mine, one of my neighbors in Rhode Island, he grows pigweed. And so he's a vegetarian, and he grills this weed, and hand to God, it smells like bacon. He tells me it tastes like bacon. I have yet to try it.
It's hard to imagine.
I can't imagine, because bacon's really good. But the fact is that he and the other part of it is some of it has grown onto my lawn, which I'm fine with because my dogs love it. So I don't know.
That's a good sign right there. That's a good indicator. Yeah.
So maybe the humans should try it. He's been trying to
send some over, throw it in a box, and
I will
and mail it out to me. I want to have
throw it on some nitrogen and cold nitrogen, and
yes,
right. So it's
sounds
nice and
good.
fresh when it gets there. All right, cool.
Yeah,
hey Chad, thank you very much. I've really enjoyed this. I've learned a lot, and I'm grateful. I'm sure our audience has as well. If people want to learn more about you as a realtor, or about Capital Giants or the equity team, what's the best way to get a hold of you and learn more about you?
Well, probably the best way to learn more about us is if it's, single family, short-term rentals, or other investment in the Sedona area, go to our YouTube channel and they can search for Equity Team AZ and they'll be able to find it.
Okay.
And if they're interested in the fund, they can either go to capitalgiants.com, which is one of the best ways to learn more about us. And there's contact info on there, capitalgiants.com. Or, people can call me as well, but all the phone numbers and stuff like that, it's on the sites, and the YouTube channel will give, all the Sedona details as well.
All right. Fantastic. Well, Chad McMahan of Capital Giants et al. I was going to list all your titles, but that's a lot. We'd be here for another 5 minutes. But hey, man, thank you so much for your time. It's a pleasure to see you, and congratulations and continued good fortune on everything you're doing.
Thanks, Ed. You as well.
Right. And like I said, I'll see you Saturday afternoon.
Yeah, sounds good. I'll be ready for you.
All right. Thanks.
Okay.